2025 tax bill, officially called the Tax Relief for American Families and Workers Act, and informally dubbed the One Big Beautiful Bill, was signed into law on July the 4th, and it's bringing big changes to how you file your taxes and what you might owe or save. And in this video, we're going to be walking through the key updates that impact your bottom line. So whether you're a working parent, a retiree, or someone who earns tips or overtime, there are important changes you'll want to understand to figure out whether this bill will benefit you. I am so happy to have you here with me today. Let's get started. One of the most important updates is something that you won't see change, because this bill makes permanent the individual tax brackets and rates first passed in 2017. Now, originally they were set to expire at the end of 2025, and these rates are now locked in for the foreseeable future. Now, that means that there's no automatic tax hike for individuals and families starting in 2026. There's easier long-term planning for your paycheck, retirement withdrawals, and investment income. So even if you don't claim any new credits or deductions as a part of this bill, this change alone could help protect thousands in future tax savings. Now, if you earn tips, there's a new potential benefit. You can deduct up to $25,000 of tip income from your federal taxable income. But there's a key condition. You have to itemize your deductions to take advantage of this, meaning you'll give up the standard deduction, which is $14,600 for individuals and $29,200 for married couples filing jointly in 2025. So unless your total itemized deductions, including things like mortgage interest, charitable contributions, and now tip income, add up to more than a standard deduction, you might not benefit from this at all. Now, the provision applies from tax year 2025 through 2028 and only to reported tip income, so accurate documentation is going to be essential. There's also now an overtime deduction. Up to $12,500 of overtime pay can now be deducted from your federal income, but only if you itemize your deductions and your income falls below the phase-out threshold. And the final limits for this are pending IRS guidance. Employers will need to clearly classify and report overtime on W-2s. So if you earn regular overtime, be sure your documentation supports the deduction. This is another case where the math really matters. If you're not itemizing, then this benefit won't apply. The child tax credit has been increased from $2,000 to $2,200 per qualifying child, starting with the 2025 tax year. Now, age eligibility remains the same. Your child must be under the age of 17 at the end of the tax year, and they must be your dependent, a U.S. citizen or resident alien, and live with you for at least half the year. Now, the income phase-outs haven't changed either. It's $200,000 for single filers and $400,000 for married filing jointly. And while part of the credit may be refundable for lower income families, that portion is capped at $1,700 per child. And this is unchanged. And of course, this won't apply to everyone. Bottom line, for most families with tax liability, this is a modest $200 per child boost. For children born between 2025 and 2028, families will have access to a new savings option, often referred to as Trump accounts. Now, here's how they work. The government contributes a $1,000 seed deposit for every eligible newborn. Families can make annual contributions of up to $5,000 with tax advantage growth. Accounts must be opened within the first year of life, and funds must be used for qualified purposes like education or a first home. The final rules for this are still pending. Now, this benefit only applies to U.S.-born children during the specified 4-year window, and contributions are made with after-tax dollars, very similar to a Roth account. If you buy a new U.S.-assembled vehicle, you may now be able to deduct up to $10,000 in car loan interest on your federal return. Now, to qualify, your adjusted gross income must be under $100,000 for individuals and $200,000 for joint filers. You must itemize your deductions, and the vehicle must be new, and its final assembly must take place in the U.S. Now, this may exclude some models, even from American automakers. Now, this provision applies through 2028, and it can be a strong incentive for buyers under the income cap making a major vehicle purchase. The cap on state and local tax deductions has been increased from $10,000 to $40,000 through the year 2030. Now, this can include state and local income taxes, property taxes, and certain sales taxes. But there are two things you have to keep in mind. This only helps if you itemize your deductions, and the benefit phases out at $500,000 adjusted gross income, so high earners may not qualify for the full deduction. And to be clear, this change isn't just for high tax states. If you pay substantial property taxes or other deductible local taxes, you could benefit, no matter where you live. For taxpayers age 65 and older, there's now an additional $6,000 standard deduction per filer on top of the regular standard deduction. Now, to qualify, you must be age 65 or older by the end of the tax year. Your income must be under $75,000 if you're filing single or $150,000 if you're filing jointly to avoid phase-outs. Now, this only applies if you take the standard deduction, not if you itemize. But it's a meaningful tax break for older adults with moderate incomes and simpler returns. While the bill introduces several new deductions and expanded credits, it also includes funding offsets that could have a major impact, especially on lower income households. To help pay for the $4.5 trillion in tax cuts over the next decade, the bill includes reductions in Medicaid and Medicare spending, including increased copays and limits on coverage options. There are stricter work requirements and cuts to SNAP benefits, formerly food stamps, expected to impact over 3 million recipients by 2034. There are limits on Affordable Care Act subsidies and changes to how eligibility is calculated, and cuts to public housing support and federal disability benefit growth. Now, while these changes won't affect every taxpayer directly, they reflect the cost of delivering broader tax relief, especially to middle and higher income earners. Now, for some, the tax savings may be offset by the increased health or household costs in other areas. And that's going to do it for today's video. The 2025 tax bill brings permanent tax rate relief and several new opportunities to save. But many of those benefits depend on whether you itemize and how you qualify. And while the tax breaks are headline grabbing, they come with trade-offs that may affect social services, healthcare, and food assistance for millions. Now, if this helped clarify where you might benefit or where to be cautious, be sure to like this video, to subscribe to the channel, and click the notification bell so that you don't miss out on the next one. And of course, feel free to share it with someone who could use a clear breakdown of these changes. Now, I want to thank you so much for watching. And as always, I want to encourage you to dream big, to live well, and to do great things. And I look forward to seeing you